Welcome to this deep dive into the Viatris, or VTRS, Q3 2025 earnings call. This one, held pre-market back on November 6th, it gave us a really complex story to unpack.
It really did. I mean, on the one hand, you had management come out with these strong adjusted beats. They even raised their full-year guidance.
And on the other hand, the market's first reaction was pretty brutal. A sharp sell-off, the stock dropped almost 6% on the day.
Exactly. And that tension, that disconnect between the numbers and the fear, that's what we're here to unpack. We have to figure out what caused that immediate pressure and then, why the stock came roaring back in the days after.
Right. It feels like a story of immediate financial headwinds versus management's very bullish long-term vision.
It is. We're going to get into the results, the new guidance, some key pipeline updates, and really try to figure out if the market is pricing in too much risk here or maybe not enough.
Okay, let's jump right in with those headline numbers that seem to confuse a lot of people at first glance. Viatris delivered a beat on the top and bottom lines.
But, and this is the critical part, that's on an adjusted non-GAAP basis. You had to put a big asterisk next to that.
Absolutely. So on that adjusted basis, what did we see?
Well, the adjusted earnings per share, that came in at 67 cents. That just crushed the consensus estimate, which was sitting around 62, 63 cents. So pretty big surprise.
Yeah, that's a 6 to 8% beat.
Yeah.
And the top line.
Same story. Total revenue hit $3.76 billion, which was comfortably ahead of the $3.61 billion the street was looking for. About a 4% beat there.
So if you just looked at those numbers, you'd be thinking, great quarter, stock should be up. But that's not what happened.
Not at all, because the market immediately looked past those adjusted figures and focused on the statutory or GAAP results. And they were not pretty.
So what was the reported number?
Viatris reported a GAAP net loss of 11 cents per share. That's a $128 million net loss for the quarter.
A huge reversal from the profit they posted the year before.
A stark reversal. And that mix and adjusted beat, but a reported loss, is a recipe for confusion and, well, for selling.
So we have to dig in. What drove that $128 million GAAP loss? Was the core business just bleeding cash?
No. And this is why we do this. It was mostly driven by non-cash, not operational things. The biggest piece was fair value markdowns on assets they kept after selling their biosimilars business to Biocon Biologics.
Okay, so just to be clear for everyone listening, Viatris sold a business to Biocon, and part of the payment was in preferred stock in Biocon.
Exactly. And when the market value of that Biocon stock goes down, Viatris has to write down the value on its own books. It's an accounting rule. It's a paper loss. It has zero impact on the cash they're making selling drugs.
Right. That's the key distinction. It doesn't affect their ability to pay the bills or their dividend.
Not one bit. And understanding that difference between a paper loss and an operational one is why the stock didn't just keep falling.
Okay, but there were also some very real, very tangible operational headwinds. Management spent a ton of time on what they called the Indore impact.
Yeah, this is the big one. This is the main factor that's been dragging on their results all year. We're talking about an FDA warning letter and an import alert at their huge manufacturing facility in Indore, India.
And what was the actual damage in Q3 from that?
It was significant. That facility being hobbled cost them about $100 million in lost revenue, just in Q3.
Wow.
And year to date, that single issue has cost them around $400 million in revenue. It also directly hit their adjusted gross margin, pushing it down to about 56%. Those are real costs.
So with that kind of a drag, management's claim that the underlying business is steady sounds a bit, optimistic. Is there any proof in the numbers?
There is, actually.
Yeah.
This is the positive hiding in all the bad news. If you pull out that $100 million Indore drag and you adjust for some divestitures, the core operational revenue actually grew.
It grew
By 1% year over year. Now, plus 1% doesn't sound like much, but when you realize it had overcome that massive headwind from Indore, it tells you the rest of their global business is actually performing quite well.
So the base business isn't shrinking. It's actually fighting its way to growth despite this anchor.
That's the story they're telling, and the numbers seem to back it up.
Okay, so what's the resolution for Indore? Management said the remediation work is substantially complete. Can we trust that?
That's the billion-dollar question, isn't it? I mean, they can fix everything on their end, update the processes, retrain everyone, but the timing for the FDA to come back and reinspect, that's completely out of their hands.
So the market is right to be skeptical until that warning is officially lifted.
Absolutely. We've seen these things drag on for ages, but, and this is important, they are actively working to de-risk the situation. They're building redundancies, shifting production to other sites so they aren't so dependent on that one facility. And crucially, they said that the financial penalty, that 100 million plus revenue loss, is not expected to happen again in 2026.
Even if the inspection is delayed.
That's what they said. They're basically insulating the P&L from that specific problem going forward.
That's a perfect transition to the real anchor of this company, which is cash generation. Despite the loss and the regulatory drag, Viatris is still a cash machine.
It really is. It's their superpower. Operating cash flow for the quarter was a very strong $745 million.
Which translates to what in free cash flow?
$658 million in free cash flow for one quarter. That FCF engine is the entire foundation for everything they're trying to do.
And it's what funds their big capital return program.
Yep. They're on track to return over $1 billion to shareholders for the full year 2025. They've already done over $920 million, including a very aggressive $500 million in share buybacks.
Which, when your stock is beaten down, is a great use of cash.
It's a powerful way to drive future EPS growth.
Okay, so with that strong cash foundation, let's pivot to strategy. CEO Scott Smith sounded really bullish on the call, which led them to actually raise their full-year guidance.
It was a bold move, for sure, but it shows they have a lot of confidence in the rest of the business outside of Indore. They raised the midpoints for revenue to $14.1 billion, adjusted EBITDA to $4.1 billion, and adjusted EPS to $2.30.
That's a pretty strong signal.
It's management saying, we believe the positive momentum is now strong enough to overcome the headwinds.
And part of that confidence seems to come from a new plan to get leaner. They announced a big strategic review.
This is the reinvention part of the story. They're looking at everything, commercial, R&D, manufacturing, corporate functions, with the goal of finding, and I'm quoting here, meaningful net cost savings over several years.
Meaningful is doing a lot of work in that sentence. Did they give any hint as to what that actually means in terms of dollars?
Not yet. They're saving the details for an investor day they've scheduled for the first quarter of 2026.
Ah, so that's the next big catalyst.
That's it. They did hint that most of the savings would fall to the bottom line, with only a minority being reinvested. So it points to a leaner, higher margin Viatris down the road. But we have to wait for the proof.
And that higher margin future is also built on their pipeline. Let's touch on a couple of the key assets they highlighted. First up, this Aculys Pharma deal in Japan.
Right. This gives them the exclusive rights to a drug called pitolisant in Japan. It's a CNS asset for treating things like narcolepsy and sleep apnea.
Why is that a big deal?
Because it shows they're moving away from just high-volume generics toward more specialized, higher-margin drugs. Japan is a huge market where they already have the infrastructure, so they can plug this right in.
And the other one was this fast-acting meloxicam for pain. Management seemed really excited about this one.
They were. They're submitting the NDA by the end of this year. They're positioning it as a non-opioid, opioid-sparing option for acute pain.
And they threw out a pretty eye-popping sales number for it.
They did. They suggested peak sales could be somewhere near $500 million.
$500 million? For a single non-opioid pain drug, that seems ambitious.
It is, but the logic is that in today's world, doctors are desperate for effective, non-addictive pain options for things like post-surgery recovery. If this drug is genuinely faster and better than what's out there, that $500 million number starts to look, well, plausible.
Okay, so let's bring it all together. We have this clear divergence. The sharp sell-off was all about the GAAP loss, the Indore problems, and just general execution risk.
Yes. The initial reaction was pure fear and a focus on the past. But then you saw that powerful 10% rally over the next week.
And what was that about?
That was the market starting to look past the noise. They started focusing on the, $2 billion in annual free cash flow and the $1 billion buyback that puts a real floor under the stock.
So the market is starting to bet on the turnaround story.
It's starting to. Management is saying all the right things, promising a more agile, more innovative company. But the stock is still cheap because, frankly, investors want to see them deliver. The execution risk is still there.
All right, time now for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on everything we just heard.
And this one is all about that mismatch we've been talking about. You have a company trading at a discount, but it's just a machine when it comes to generating cash. And it's using that cash to shrink itself.
So we're betting on the turnaround. What's the trade?
A high-conviction long Viatris position, We're calling it the cost-cutting and capital return play. The idea is that the billion-dollar plus in annual buybacks and dividends creates a really strong floor for this stock.
It's like a constant source of demand for the share.
Exactly. It makes it very hard for the stock to stay down for long. The post-earnings shakeout might have been the best entry point.
And the big catalyst that makes this trade work.
It's that Q1 2026 Investor Day. That is the moment of truth. If management comes out and quantifies meaningful savings, as, say, hundreds of millions of dollars a year, the market will have no choice but to re-rate the stock higher.
They'll be forced to look forward. And what about the safety net? What if something else goes wrong?
The safety net is that they're already de-risking the single biggest issue, Indore. They've guided that the financial pain from that won't repeat next year, and they're building redundancies. So you're taking the biggest known risk off the table. We see a low to mid-teens % upside by the middle of 2026 as this story plays out.
Okay, to quickly recap this deep dive, Viatris gave us a strong operational quarter, but it was completely masked by a non-cash GAAP loss and that $100 million drag from the Indore facility.
Right. But management is on the offensive. They're addressing the risks, and they're launching a major cost-cutting plan. The foundation, that $658 million in quarterly free cash flow and the huge capital return, is incredibly solid. All eyes are now on that Q1 Investor Day.
So the provocative thought we want to leave you with is this. How big of a discount should a company get for execution risk when it's generating a guaranteed $2 billion a year in free cash flow? Is this a genuine value trap, or is the complexity creating an opportunity right now before those savings get announced in Q1? Thank you for joining us for this deep dive into Viatris' Q3 2025 call. We'll see you next time.